So to understand a little bit more about the market and where interest rates are, I think it would be a great idea to take a look at where we've just come from, which are historically low interest rates, where we are right now, and then learn a little bit more about where the future is going to go with rates. So we were in historic lows, at the beginning of the year. We were like in the 2s and the 3s. So tell us a little bit about why we were there or how we got there and where we are right now.
We were in Lala land, guys. We really were. I mean, we were in basically a place that none of us could have ever imagined we would get. Who would have thought a pandemic of all things would have gotten us there? Yeah. A little squirrely on the front end of that, but it did. It led to some of the lowest rates any of us have ever seen. Not entirely sustainable, right? So when we're lending money, it costs money to buy money, it costs money to lend money. There comes a point at which that's no longer sustainable or feasible. So right around October, we started to see some adjustments. And after January 1st, it's actually January 3rd, so everyone got back and got comfortable with flipping their calendar over into the new year. And then it's been an increasing trend ever since. It's been a great market. It's still a great market. Up until recently, we've really still been in historic low rates. And what we're seeing is nothing to be afraid of. I think that's the most important message. It's not permanent. And we are seeing this increase, most importantly, not as a result of the Fed increasing the rate.
Wait. Say that again.
This is not the Fed's fault. That might be overly political, but it's not tied to the Fed rate.
So what is it tied to then? Because that's, when I turn on the news, when you listen to the media, open a newspaper, it's a little scary because you don't really know exactly what's happening other than you hear everything's going to cost more. We're in a recession or heading into one, and interest rates are going up, and oh my gosh, I can't buy a house anymore. So explain a little bit about what you mean by that.
Yes, so inflation is basically the cost of anything, any number of things. So inflation means those costs are going up. What we have is an inflation rate that is at a 40-year high.
Wow.
Mortgage interest rates are tied to inflation, not the Fed. So we are at about an 8.5% increase in inflation, the rate of inflation, in just a year's time. A really compressed period of time, we've seen that sharp increase. So rates have followed. Mm-hmm. Now, the Fed increasing the rate is actually designed to help offset that. So do all of ourselves a favor and just try to keep that in mind. So when the Fed's increasing the rate, it does not mean you are less likely to afford a mortgage. It does not mean that buying a house in and of itself is going to be more expensive or less viable for you.
So at the beginning of the year, we were in the 2s and 3s for interest rates. And so we've come up right now, almost midway through the year, about 2 percentage points in interest rates. Is that about right?
Absolutely, 2 to 3, depends on the loan profile. And that's something we're seeing also. Every loan profile there's so many factors in an interest rate. So while it's easy to see certain rates online for better or for worse, this is scary. This is maybe not actually realistic. This is why we need to speak with our lending professionals so that we're in a position to understand exactly where we stand. Are there ways to optimize, remove inefficiencies from our overall loan application to be in the best position to buy?
So that's where we are right now. And I totally agree that one of the first people actually when buying a house, I always recommend that they talk to a lender because that's really going to give you the numbers that are for you. And when you break it down, you can hear all of the news and read everything in the paper, but what does it actually mean to a potential buyer and what can you actually afford? So let me ask you the question then, and I feel like this is a hard-hitting question. Are you ready?
For it?
Where are we going? Because everyone's going to want to know where interest rates are predicted to go. How long are we going to be in, an increasing interest rate position? What does that look like? And where do we look for the data besides this great video where we're going to tell you?
So what we all need to do is take a deep breath. I kind of compare it to that moderately uncomfortable feeling after Thanksgiving dinner. Okay, so that's kind of where we are. We're inflated. We're in an inflated economic environment. Is it permanent? Probably not. Just like after a good nap and, maybe a fresh mindset, maybe a little sweat on the Peloton, you start to feel better the next day. Yeah. And that's kind of where we are. So moving forward, we are probably not out of that trend of increase in the mortgage interest rate market. It's likely to continue right alongside inflation, as we mentioned, and it is expected that, according to all the technical analysts who I compulsively follow for this information, that inflation should start to taper off somewhere around October. And did you know how we're getting there?
No.
Inflation is going to be controlled by some of the Fed interest rates increasing. Can you believe it? So they seem scary, but they're actually working in our favor as lending professionals. I know, mind blowing. So when the Fed increases their rate, they're doing that. And there's all kinds of examples historically. Alan Greenspan most recently, when they increase the rate, it's designed to bring that inflation into check and since interest rates are tied to inflation, when it starts to level out, so will these rates. So we can get there. Unbutton the button. Take a deep breath. It's going to be all right.
So, I mean, we're not trying to make light of where we are right now, but that being said, I think that gives you peace of mind because it is actually based on data that you're looking at.
Absolutely. This is technical data provided for folks who are way above a different pay grade than I am. But, I value that information. It's really important for us to be able to layer that into any buyer's financial strategy. A mortgage should complement your financial strategy. It is a way to build wealth for your family now, for the future. It's a legacy purchase. And if we wait too long, we're going to miss out on that magic equity that we could have otherwise gained. So that's something to take into consideration as well.
Absolutely. So I think what we're saying, or what I'm hearing, is that, so yes, we heard interest rates were in the 2s and the 3s. We all know that. Where we are right now is a couple percentage points above where we were. And it looks like, yes, that interest rates might continue to climb, but that there will be some relief in the future. And we're looking at maybe, I think you said around October.
Yes.
It's looking for it to level off potentially.
Yeah, so that's a lead indicator. So once that inflation starts to taper off, the market will follow. It's probably not going to be instantaneous, to the point that I wouldn't say it's worth waiting to ride that out. Because when you ride out the interest rates, if you wait maybe the 18, 24 months to get back into the 4s or 3s, depending on the overall scenario where we land, you might be missing out on tens of thousands of dollars of wealth in the form of equity in your home. You're going to spend more for a house.
Right.
We are still in an appreciating market. It may not be quite as intense as it has been for the past 2 years, but we're going to stabilize into a single-digit appreciation, which is healthy, sustainable, and it's a reason why you should still consider buying. There is still going to be an appreciation trend moving forward.
So then let me ask you a question. If someone were to buy right now, right, and they lock in at their interest rate, and I don't know, I'm just going to throw a number, it's in the 5s, right? And then we do see that the interest rates are coming down at some point, maybe in a year or so. Can't they refinance?
Totally can. And this is an important part of our conversation. So there are conversations that are important to have that enable you to be financially prepared. And this strategy, this mortgage, if you're purchasing this summer, this is a strategic move. This is not a lifelong 30-year commitment in most cases for most clients. So this is a means to an end loan. It is a way to do something that is probably underrated in terms of the overall home buying process, which is to create stability. If you're renting, your landlord, you're paying his mortgage, and he has the ability to tell you what you're going to pay. Not the case when you're in a mortgage. You can create stability. In fact, if you buy in a higher interest rate market, you're almost building in a cushion for yourself in the future if the rates come down, because your payment could therefore likely become lower in the future. So create stability by locking in your housing payment. 30-year fixed rate mortgage is not going to change. The payment itself, the principal and interest portion itself, is not changing for the life of the loan. So that's very important to remember. This is a way to get on the leading edge of that equity curve, create some stability for your finances, your family, and then plan with your lending partner what that looks like in 12 to 18 months when those rates come back down.
So we started off this video talking about the bubble going up, and you're saying that we're not going to see the pop.
We are not. And that's, again, based on several factors. There's a few reasons that this market is not going to crash. Number one, supply. Good old capitalism. Supply is low. Demand is so high. Most importantly, from where I'm sitting, is the mortgage lending world is completely different than where it was in 2007, 2008. There's so many more protections in place for all of us, and we're making really good choices and doing things like planning in advance to ensure that we're not setting ourselves up for anything other than success.
And there's more, I know that there's more requirements for loans.
Absolutely.
And things like that. Credit scores have gone up, I think.
To a certain extent, yeah, we have lots of options. There are still some flexibility there, but what we're doing, the prevailing mortgage guideline and the thought behind most of the guidelines is seemingly very simple, but it's so important. We are helping to ensure that our clients have the ability to repay their mortgage. It's a much safer environment for all involved, again, because our goal is to help create stability, success for our clients. I want, little Johnny to be able to grow up in his bedroom and stay there forever, right? That's the goal.
If you're looking at being a buyer right now, what are the two biggest tips that you would recommend?
Oh, for sure. So number one, I've said it a couple times now, be prepared. Sounds cliche, knowledge is power. The more you know about not only your finances, but your future plans, the better position you're in. Imagine walking into a home, and instead of asking, oh my gosh, I wonder if I can afford this kitchen, you feel confident in what your offer price could be, your cash position, your strategy, any number of factors. So be prepared. Get as far away from that front door as possible. speak with your lender, consult with your team about what strategies are necessary in the market. And I think the second tip, which might sound a little bit Pollyanna, is just stay positive. Take the media, take other influences, God bless our families, take even their opinions with a grain of salt. When you are prepared and you have an understanding of your financial picture, it gives you the freedom of being able to recognize that this is just short term. Keep your wits about you and try to enjoy this process because it's a great opportunity.
And I will throw in the third tip, and it's definitely without a doubt, talk to a lender. And that's really one of the first people you should be talking to in the process, especially when you're trying to figure out how much can I afford, what is my payment going to look like, and really getting an understanding of what the market and the interest rate would look like for you. And there's also all different types of loan options, which we're going to talk about in another video. But you want to make sure that you're also setting yourself up for success and for your future. And then one of the first places that it starts with is actually her. So call the lender, call me, call the lender, because in tandem, the realtor and the lender do work really closely together to make sure that you're set up for success and building wealth in your future by owning a home. So hopefully this video was helpful for you. I'm Ginger Walker, the team lead of Give Back Team in Northern Virginia, and I'm joined by
Jessy Printz with the Printz team at USA Mortgage.
And thank you for watching this episode of Give Work Play. And I'll give you a little tip. Stay tuned to this channel because you know what? We're recording more videos. I'm not letting her go. So stay tuned because we're going to put on some more videos as it relates to lending, the different types of loans, and how we can help set you up for success in your home buying process.